Luna and UST have both collapsed. There's been a proposal for a new fork similar to ETH and the infamous the DAO hack to try and rebuild what is left. But what exactly happened to Terra? Is this the result of some large hedge fund manipulating prices as some have speculated? Is Do Kwon pulling an exit scam to try and get away with as much money as possible? Today we will take a look at the rise and fall of Terra, Luna, and UST. I'm Average Crypto Investor, and as always, nothing said in this video is financial advice, and you should always do your own research before investing into any project. First, let's cover what exactly is Terra, Luna, and UST. Terra is a blockchain started back in 2018 by Terraform Labs, a South Korean software company. Terraform Labs was also incubated by the Terra Alliance, which was a group of 15 Asian e-commerce giants. Do Kwon has served as the CEO of Terraform Labs since its inception, while the other co-founder, Daniel Shin, left in 2020 to start the Chai Corporation. Terra's development is developed by LFG, or the Luna Foundation Guard, which is a Singapore nonprofit. Terra's mainnet went live in April 2019, and its blockchain was built with the Cosmos SDK. This means that it can process thousands of transactions a second. It also means that Terra is a proof-of-stake blockchain, hosting roughly 130 active validators before their collapse. The goal of Terra was to build a blockchain to power the future of decentralized payments, savings, and investments through its ecosystem of decentralized applications. Luna is the native token on the Terra blockchain. It is used for staking, paying gas, as well as a governance token within the Terra blockchain. Luna is also used to ensure that the stablecoin in the ecosystem, such as UST, remain pegged to their respective currency. The way Luna is able to assist with the peg is through their mint and burn mechanic, as well as normal arbitrage activities. The way the mint and burn works is really quite simple but novel for the time. For UST, you could always mint 1 UST by burning $1 worth of Luna. You can also mint $1 worth of Luna by burning 1 UST. When UST is above peg, you can sell it on the open market and receive more than your dollar is worth. When UST is below peg, the arbitrage opportunity is to buy UST on the open market, mint $1 worth of Luna, and then sell that Luna for $1. This is what makes UST an algorithmic stablecoin. If you're unfamiliar with stablecoins and would like to learn more, I suggest you check out this video up here. If you're new to the ecosystem, this can seem complex, but we can compare it to most monetary policies. Let's first start off by assuming Luna is trading for $10. You could go in and burn 1 Luna token for 10 UST. Let's say UST is currently worth $1.25. If you burn this UST for Luna, you would still only receive your 1 Luna token back since you have 10 UST, and each UST is worth $1 of Luna. The better choice here would be to sell that UST to someone else for $12.50 worth of assets. On the flip side, let's say that UST is currently worth 50 cents. You could then go and buy 20 UST for the same $10 and burn that for 2 Luna tokens at this time. You could then sell the Luna token for an instant 100% profit, assuming all things remain the same. The problem with this formula is things work pretty well during a bull market, but have a tendency to blow up during a bear market. This is one narrative of what happened with the decline of Luna and UST. During a bear market, most tokens tend to lose some value as investors move risk off the table and speculative demand starts to dry up. This causes Luna to begin declining in price overall. Then, as UST holders begin to fear that the peg may not hold up, they either choose to sell their UST and exit the position, or burn it to receive Luna and cash out. However, as UST is burned, that means more and more Luna is being minted, increasing the supply. As we know from our supply and demand curves, as supply is being increased and demand is decreasing, the price is going to rapidly fall. The supply curve is also exponentially increasing because when Luna is worth $100, then 1 UST only mints 0.01 Luna tokens. At $10, 1 UST mints 0.1 Luna tokens. At $1, 1 UST mints 1 Luna token, and at 10 cents, 1 UST mints 10 Luna tokens. So each 90% decline in Luna value gives a 10 times multiplier to the amount of Luna being minted for each UST. For a long time, each time a user minted UST through burning Luna, there was a seniorage fee paid which went into the community treasury wallet. In September 2021, the fees collected had grown to an impressive $4.5 billion, and the community voted to burn that for roughly 4.5 billion UST. This was part of the Columbus 5 initiative, which was focused on expanding UST's ecosystem to other blockchains to increase its usage. Once UST was bridged to other blockchains, there were several liquidity mining incentives put in place to encourage the explosive mass adoption the Terra Labs team was hoping for. Since there was an additional incentive put into place, the demand for UST was exploding, seeing it bounce above its $1 peg frequently. Whenever UST was above its $1 peg, this would encourage investors to buy Luna and burn it to take advantage of the arbitrage opportunity. With the increased demand of Luna and the constant burning to get more UST, we saw Luna peak in April 2022 of roughly $120. This also caused UST to become the third largest stablecoin by market cap and saw mass adoption by virtually every decentralized and centralized exchange. It is impossible to talk about the explosive growth of UST without mentioning Anchor Protocol. Going back to the goal of Terra of building a decentralized platform of payments, savings, and investments, Anchor Protocol was solving for a decentralized savings platform. Before the collapse, Anchor had roughly 80% of all UST locked within it. They were famous for offering a stable 20% APY on deposits and were being touted by many folks as the best place to keep your liquidity for a safe return in DeFi. But how was Anchor able to achieve such high percentages? Well, it was through their bonding process with proof-of-stake assets. Anchor would allow users to deposit assets like bonded ETH, bonded Atom, staked AVAX, bonded Solana, and bonded Luna in exchange for their token ANC. ANC was a governance token for the protocol and would allow users to control the direction the protocol was going. In addition, Anchor was making the promise to buy back or burn ANC in order to drive the price up, which would result in holders of ANC seeing a profit if sold at a later date. The returns from the bonded and staked assets would be used to pay into the yield reserves, which then in turn would be used to pay out the famous 20% APY. As we saw with Terra, this worked much better in the theoretical market than the actual market. Most people were holding their UST on Anchor to get the 20%, rather than those who were depositing bonded assets, so the yield reserves were depleting as time progressed. Now, in Anchor's defense, they were aware of the situation and were working on adjusting the APY percentage before the collapse of Luna and UST. However, in the meantime, Terra injected $450 million worth of UST to help them sustain while the governance votes took place. Now, leading up to the collapse of UST and Luna, the Luna Foundation Guard had proposed backing 20% of UST with Bitcoin. They had started raising money and were buying Bitcoin during April and May with the goal of backing at least 20% of UST's market cap with Bitcoin. This required them to acquire roughly $3 billion worth of Bitcoin, which they accomplished on the 5th of May through gifts from Terra Labs, as well as VC money from Genesis Trading, Three Arrows Capital, and Jump Crypto. All of these would make an individual think good news for the Terra ecosystem, since the backing of UST would eliminate the potential for a death spiral from a market run. Just a few short days later, on May 7th, we would see the events put into motion for a complete collapse in this retrospective. On the night of Saturday, May 7th, the Terra team removed a huge amount of UST liquidity from Curve Finance, a protocol that many folks are familiar with for offering yields and exchanges on stablecoins. Now, Terra had pulled that liquidity with the best intentions. They were planning on moving to another pool, but it left them exposed. Shortly after this liquidity was pulled, there was a whale who swapped 85 million UST for roughly 85 million USDC on Curve Finance. That resulted in UST first dipping slightly below the peg. Now, since the crypto market has been sliding for a few weeks already by the time of May 7th rolled around, the UST depegging spooked a lot of investors. This caused many folks to begin liquidating their UST both through burning and swapping for other assets. The folks that swapped for other assets drove the price of UST further down, while the folks that burned for Luna needed to sell Luna to get back their profits, causing the price of Luna to start dipping. In the first 48 hours after the depegging occurred, $9 billion of Anchor's $14 billion worth of assets were taken off the platform. Since investors were trying to de-risk, This meant many folks were selling their UST for other assets, causing UST to further dip below peg. Now, as we mentioned before, as long as there was buying demand for Luna, you could continue to burn your UST and get Luna, and then sell when UST was below peg for a quick profit. As soon as UST's market cap was greater than Luna's, that meant Luna could not recover and was entering its death spiral. This saw Luna's supply grow exponentially and its price crumble by the hour. With the price of Luna declining, it put the whole Terra blockchain at stake. Since Luna is a governance token and staking on validator nodes on the Terra blockchain, it was getting increasingly easy for a malicious actor to come in with a 51% attack on the chain. To give everyone some breathing room, the Terra validator nodes agreed to halt the blockchain on May 12th. Upon resuming the blockchain, on-chain swaps were disabled and the mint and burn function was also disabled. While this was happening, in the background, LFG was trading their $3.5 billion worth of BTC to try and restore the peg. Ultimately, this wasn't successful, and by the 13th of May, $40 billion was lost through UST and Luna. So ultimately, who is to blame for the downfall of Terra? Well, as of right now, we don't know for sure. What we can do is look at motivations and who has something to gain. Ultimately, virtually every crypto VC and ecosystem had exposure to the Terra blockchain in some way. UST was being bridged across every chain, which makes it unlikely for someone within that sector to be the culprit. There is the potential that someone who is a Bitcoin maximalist was trying to get some Bitcoin on the cheap by causing LFG to have to sell their Bitcoin, and so that way they could scoop it up cheaper, but I find that situation dubious at best. The next choice is Wall Street, and ultimately it's an interesting choice. There have been some accusations thrown around at specific firms, but I haven't seen any concrete evidence. However, the fact that the Fed released their financial stability report on May 9th, the Monday after the crash, and then Janet Yellen spoke about UST's depegging during her testimony to US politicians on May 11th, if you are at all familiar with how antiquated and slow-moving the US government systems are, it seems like the Fed release is coincidental, but Janet Yellen's testimony is somewhat of a red flag. There's a potential that there is someone close to her that informed her of what was going on before the testimony, which does point to Wall Street and some old money. The last potential actor is someone within the Terra team. Now, there are ways to be alerted when liquidity is removed from protocols and make trades automatically through code, but the timing of the curved trade so quickly after Terra removed liquidity raises the question about someone in the team making this move. With that being said, there has been speculation around Do Kwon himself being behind this. On May 4th, Terraform Labs Korea's headquarters was dissolved, and on May 6th, the Seoul branch was dissolved as well. This was just days before the collapse started to happen. I again am not sure about this narrative due to the hard fork that is being proposed by Do Kwon himself. I personally do not like Do Kwon and his ghoulish personality, but I don't think he would have blown up the protocol and drained the LFG in this way if it was truly an exit scam. So what does that mean moving forwards? Well, there is a hard fork being proposed for the Terra blockchain that could be a moment similar to Ethereum, the DAO hack. However, I don't see Terra ever scaling to the point it was. There was heavy VC involvement to get Terra built up, and I have a feeling that most of these investors will not want to double down on a failed investment. In addition to that, many of the things that made Terra Chain great were the decentralized applications built on it, such as Anchor and Mirror. I think most of these projects will begin building on other chains that don't have such a negative reputation associated with them. Ultimately, this whole situation sucks for a whole lot of people, and often the investors who are hurt the worst are retail investors. So what can we learn from this situation so we can move forwards? Well, for us retail investors, it is always important to understand how any money you are being paid is being made by the protocol. With Anchor being the single largest project failure I've seen in terms of total value locked, it's easy to understand why, with hindsight. It is important not to get distracted by easy money and high yields in order to build a portfolio to sustain any market. It is also important to diversify what you are DeFi. There are tons of different ways smart contracts can be exposed to risk, and without proper diversification, a single breach can wipe out your entire portfolio. Are you going to be investing in Terra's new hard fork blockchain? Do you think Do Kwon is behind the hack, or is someone else out to get him? Let me know in the comments down below. As always, if you learned something here today, why don't you like this video to help others find it? If you want more of this type of content, subscribe with the bell notification turned on so you can be alerted when my next video goes live. That's all for now, stay safe, and don't worry crypto fiends, we are all going to make it.